Welcome, everyone, to another exciting episode of the YouTube show and podcast. We've been off for a couple of weeks, but we are back with gusto. And not just the payroll firm that you may know about, but no, we're back with the meaning of the word gusto. We're back with energy and ready to do a great show today. What we do here is we talk about news in business, accounting, finance, sometimes not in any of those categories. And we do that all from the perspective of accountants. With me today is Tammy Hess.
Hi, everyone.
And Charlie Zigmund.
Hi, everybody.
And I'm Ty Carr. And here's what we're talking about today. From Accounting Today, what should CFOs address with their teams in 2022 for success? Then from Polygon, first run movies streaming causing piracy to soar. What do we think about that? Then I'm going to share with everyone a reminder from the IRS about the employee versus contractor issue. Then we've got a topic on Venmo and PayPal tax reporting and some issues around that. Then chicken price fixing. I assume here we're going to be talking about the meat. And finally, I'm going to end with a philosophical discussion on book tax, why that may not be a good policy or why it may be an okay policy. We'll talk about it from both directions. Okay, well, I'm glad to get this going here in the new year. So let's kick it off. I'll send it over to Charlie.
All right. So I've got an article we can talk about from Accounting Today called 5 Ways That Finance Teams Can Elevate Their Business in 2022. And so kind of the premise of the article is that, for a bunch of organizations, moving to remote work in March of 2020 made everybody have to deal with a lot of challenges and issues that they didn't previously have to deal with. And so this article just kind of talks about different ways that they can address those sorts of things and kind of things to be on the lookout for. And before I go through the list, I just want to kind of get your guys' take on if this is what you think that firms in that industry should be focusing on. So it says, to address issues of burnout and retention, CFOs should focus on making work less tedious and more engaging. It says that remote and hybrid work models are here to stay. The CFO will play an important role in helping businesses adapt. Supply chain issues are going to continue to increase to impact companies, and they're going to require extra attention from the finance department. And then CFOs will increase use of real-time data to drive business performance in the face of continuing ripple effects of the COVID-19 pandemic. And, along with supply chain, inflation, taxation, and other uncertainty. And then finally, the last point they had was that as companies return to business travel, an increase in in-person events and new travel policies will require policy and budget shifts. So what do you guys think? Is this a good list? Are these the things to be watching for in 2022?
Yeah, I definitely think it's a good list. And I think that the biggest one about the remote work style is here to stay. And I think that there was a lot of reluctance, prior to the pandemic about, a lot of folks didn't want people to work from home and, didn't think they got the most efficient use of the time and all this kind of stuff, where I do believe that people have proven that we can work from home, whether because of Zoom meetings and all these other type of infrastructure that we do have available to us. But I do think that there is the key thing is probably flexibility, because I think that there's, a lot of folks that I've talked to have missed going into office situation and having meetings with like a live person or sitting there and the conversations that happen after the meetings or before the meetings. And you don't really get that in the Zoom kind of world that we have now. So I would say the flexibility of offering the remote and in office is going to be really high, of high value in 2022. The other thing I think about though, is in terms of the burnout comment that list had, I think that was there prior to the pandemic. You always had to kind of keep an eye out of what causes employee burnout, and if it's the tedious work or if it's, work-life balance, if it's, various different, types of things that people should be always keeping an eye on that, because burnout can happen whether you're remote or if you're in the office. So to kind of think about that in a bigger kind of view. What do you think, Ty?
Yeah, I agree with those points. And the two that I honed in on, the using more real-time data, I think we hear that every year. I think that's like, okay, if you're going to do a list for the beginning of the year of what are you going to embrace more of in a finance department? More real-time data, right? We're going to always hear that. So that makes sense. Of course, we got to get that in the list. I guess I relate to the in-person events and new travel policies piece of it because, in our firm, we provide that kind of CFO outsourced accounting function for companies. And because we started with several clients during the pandemic, you have a scenario where during the pandemic, they weren't traveling. So, then we were living through a period where people weren't traveling, and then all of a sudden they are, and they're expensing things on their expense reports, and we're like, oh yeah, we don't exactly know how to categorize all that stuff because people weren't actually doing these things before. So what is part of their travel and entertainment budget, and what is part of some other budget? And that's a real question that is coming up that I see sometimes, that we are finding out what we didn't know because the activity just wasn't happening while people were shut down.
No, absolutely. I think it'll be interesting to see how it all plays out. And, we'll be here keeping you informed as we go through the year. Do you have another article we can talk about, Tammy?
I do. So before I go into the article, I wanted to take us back in time where we popped in the rented VHS tapes of the newest movie that was available for us to watch at home. Before we could start the movie, the video of the piracy warning would appear, reminding us that piracy was a crime and that we best not do it. Some may have thought back in the day, like, what's the harm? The copy tapes were usually of poor quality, and were available like ages after the movie actually had become available in the theaters. So, those that actually wanted to see the high quality version of the video would have already seen it in the theaters. They would have rented it directly from a video store. Remember those back in the day? Purchase a valid copy at a store, and the movie industry was still making lots of money. Well, let's fast forward, pun intended, to the present day where the newest movies are streaming at the same time that they are playing in the theaters. In an article from Polygon, the movie industry is now allowing folks to watch the movie in their homes or in the theaters, giving a little bit more flexibility. And they can do that by paying a fee for a one-time download or subscribing to a streaming platform that allows for that movie to be played and or other, obviously content that they have available. But it is also allowing piracy to soar. So now what may have been considered a minimal harm to the movie industry has become a much bigger problem. It is hard to see exactly how well a movie is doing, not obtaining all the data, in terms of the true viewership. Movie stars are suing for breach of contract because they aren't happy that these things are being available and impacting what's considered box office hits. And it also appears that the movie isn't dominating in either the home or the theater space. An example the article gave was a recent movie called The Black Widow has been pirated more than 20 million times, which may equate to roughly $600 million of lost sales. Now, some say offering the movies on the streaming platform may drive ongoing subscriptions to that platform. For example, some streaming platforms saw about 2 to 4 million of new subscribers after making a movie available on their platforms. But others are saying that this method is actually causing the movie industry and stars to lose a lot of money. A studio executive was quoted as saying, "You have to remember that we are still in the middle of the war. Because of that, we'll continue the same strategy that we have for the last couple of years, total flexibility." A couple of questions for you both. What is the best strategy for the movie industry going forward? And has the harm in piracy really increased?
Yeah, I mean, I think that they have had a lot of damage done as a result of making piracy more easy to accomplish. I mean, there's all these different sites and services that didn't used to exist that I think just make things so much easier. And it's going to be one of those things where the industry has to adapt to some extent by changing the way that they offer services, like through on demand and subscriptions and whatnot. But to some extent, you're always going to have people who are just refusing to pay for that service. And so there's some people who aren't actually in the market for what you're selling. They're just ready to watch it if it was free. And so I think for that group of people, it's a much different challenge because it doesn't really matter what method you try to sell to the client to that group, because that group's not participating in your game at all. And so I think it kind of goes into different categories, but yeah, I see both sides of it. I mean, on the flip side, there's all these different, there's open source software has become this big movement, and it's a lot of people who believe in the idea that you should be able to share the things like ideas and content and whatnot. And there's different types of ways that they've tried to implement that. So I think that with those in place, it makes the people who then pirate a little bit more immoral, because they're basically just standing in the face of the system, I guess, so to speak. But yeah, that's what I think about it. What do you think, Ty?
Yeah, I think the industry will have to adapt to the new reality. They'll have to come up with new ways of how they actually make their money, which isn't necessarily going to be on we make money directly from people viewing the movie. There might be indirect, well, there are for sure, there always have been indirect revenue streams from movies. And it may be that those indirect revenue streams are what becomes more important in the long run, because same thing has happened in the music industry, with the ubiquity of music videos and things that are pretty much available for free, online through channels, YouTube, other places that you can watch. I think that most artists have accepted and embraced a lot of that. There's still some holding out where, there's some amount of trying to charge and put themselves behind gates and things like that. But I don't think it'll work in the long run. And I've thought about this from a different angle too, and that, beyond just the question of how do producers make their money, how do studios make money, the streaming of movies changes it changes the experience. There is a paradox here of that is fueled by the nature of human beings, which is that streaming a movie in your house is a different experience than going to the theater with the popcorn and the candy and the drink and sitting and watching it in that theater experience. And so I think some people look at that and they say, yeah. And so when circumstances are different otherwise, then maybe people will go back to that. I have a different view on that. I think that it is a different experience. I think, was it Martin Scorsese who basically said that streaming it was one of those big directors who, just railed against streaming as basically ruining movies, right? And I think what that director was getting at, I'm not sure if I'm citing the right one, but what that director was getting at is totally true, that the method and the medium of story delivery, the way that it has been designed for the theater, where everybody comes into the theater for that experience, is probably on its way out. Oh, it may take a while overall, but it's probably on its way out, because even though people will recognize that the theater is a different experience and perhaps a better experience in some ways, or it provides experiences that you don't get from just streaming it in your home. Streaming in your home is just too convenient. So I think from, most people, they're going to cut to the chase and be like, yeah, maybe streaming in my home is not as cool on many different fronts as watching it in the theater, but it's still a lot easier than getting in my car, going out in the cold, in the December, watching them, getting arm to arm with everybody else and watching the movie. I'm in a clean, comfortable, warm space in my home, and I can stream the movie, and it is a different experience that way. But human nature is going to drive me towards that experience. So I think what I'm saying about all that is that the convenience of streaming, and which I think goes hand in hand with its ability to be pirated and basically available for free, is creating a new experience for telling stories through movies. And not only will directors and artists have to adapt to that medium, that new kind of experience of what does that mean, and how is that experience going to be different in storytelling than preparing it for a theater, but of course, the studios, back to what this article is really about, the studios will have to adapt their revenue models accordingly. That's what I think is going to happen here.
Yeah, I couldn't agree with you more, Ty, because I was thinking about that, and from my perspective of like, I probably have streamed and obviously purchased them in terms of some of the more recent movies than I wouldn't have even gone to the movie theater for, where it's just like I just wouldn't have taken the effort. And I think that there is a lot of untapped consumers out there that are like, yeah, I'll actually do that at home, because it is easier, especially if you have children, or if you just don't really want to go out, or you don't want to spend $50 on a box of popcorn, or any of those types of things, that it does actually, you could get more viewers that way by offering it. But maybe, trying to figure out a different way to, to combat the whole piracy part, but also like to get the data and the information. Because I think that's the other piece that it doesn't necessarily have to deal with dollars. I mean, it kind of does in a way, but understanding like how many people did watch it, how many people did want to see it, and if it's a really good movie or not. Because in one of the cases, basically when a movie star sued, they said that, hey, the reason why it didn't do well in the box office was because it was available online, where maybe it was because it was a bad movie. It's like you really don't know what the data is because it's not necessarily available. So trying to understand, actually getting that data source would be great too.
And don't get me started on meta, right? Like what happens here in the metaverse, like when you're talking the whole cinematic experience is based on this idea of telling a story in two-dimensional images that are the inherent limitation of the fact that it's not live theater, that you're not sitting in an immersive environment where 360 degrees around you, the story is unfolding. That physical limitation created the need for the emergence of the art form of cinema, right? So, if directors and artists and everything are concerned about what's happening now with streaming, just wait, because as we get into the metaverse, what's the art form of, the limitations that created the need for the art form of cinema have been lifted in some regard. And so is there really an art form there if those physical limitations no longer exist? It's a good question. The movie nerds will probably scream to their top of their lungs that, of course there is. Cinema is here to stay forever. It's its own art form, and it's like books, and you'll always have it no matter what happens in the metaverse. But we'll see.
That we will. So time will tell.
I think you're exactly right, because I've seen I've heard of these like live concerts that people will go to, where they'll put on like the VR and there will be a concert that they're listening to, but they can look around and see whatever that they want. And so it's kind of the same issue, but just playing out in the music industry as opposed to film. So it'll be interesting.
So I've been having an idea for us here at TCA. What if we all got those headsets and everybody had to go into the office every day? What would you guys feel about that? The virtual office, I mean.
It's going to mess up my hair, so no.
Yeah, I don't think I can handle that. That's a little too meta for me.
The IRS had put out a reminder at the end of December. They do this occasionally, and it makes sense they would do it at the end of December, just before the new year. A reminder about the employee versus contractor question. We've talked about it on this podcast and YouTube show before, in terms of what does that mean to be a contractor versus an employee? And one of the answers here is there isn't necessarily a slam dunk bright line test, and the IRS's reminder kind of highlights that point. They say, they point out that they follow what they call common law rules, which is based on court cases and the and the predominance of court doctrine as to how you define the difference between an employee and a contractor, an employee and somebody who is in an independent business. But the core issue that the IRS has in their reminder, which is always been at the heart of the issue, is can the business who is hiring the employer or contractor, does the business have can they direct or control how the worker performs the task? So if they're not just asking the worker to accomplish something, but they're basically directing how they accomplish it, there's a wide scope to what that means, directing how somebody accomplishes, and in reality, in practice, that happens in a variety of ways that you might or might not control on both sides of this equation, whether it's an employer or contractor. Like, do they have to accomplish it during certain times of the day? Do they have to accomplish it while you're watching them do it? Do they have to accomplish it with the tools that you provided? I mean, these are all kinds of questions that get into that. But the IRS specifically pointed out some of the things that they look at for this purpose. And they say, well, we're looking at the substance of the relationship between the business and the worker, not the labels. So just because you call somebody a contractor or you call somebody an employee doesn't make it so. And I see this a lot, where companies will have somebody and they'll have them sign a contract. They'll have them sign, they'll even put independent contractor contract at the top of the contract. And it'll say, this is an independent contractor contract. And the worker has agreed that they're an independent contractor and not an employee. And they think that somehow is protecting them in this issue. It doesn't, right? Because this is what the IRS is saying exactly, is that you labeling it in some contract like that does not change it. And by the way, if you're the company and you create that contract and hand it to the worker, that kind of indicates that you're controlling the work, right? Because normally, if the worker is in fact a contractor, their own business, they have clients, they're just providing a business service to you as a business. Typically, the way business works is that the worker would have the contract, like what we do for our clients. They would have an engagement letter or some kind of contract that they use with their clients that they would have the company sign, not the other way around. When the company is having the worker sign their contract, that's I would say that's one of the first flags that this is probably not a contractor. It's probably an employee, because that's what happens in the employment situation, is that companies have their workers sign employment contracts, but they're signing an independent contractor contract as created by the company. To me, is highly suspicious in that kind of scenario. But moving on, I'm diverting here into some of my own pet peeves. But what the IRS says on this is, is the worker receiving benefits? Are you not only paying for their time, but are you paying for insurance and maybe providing them some kind of pension or retirement plan, paying for vacation or sick pay? Those would indicate that they're more like employees than like contractors or separate businesses. How long has the relationship been going? I mean, are they working exclusively for you and for long periods of time? That would indicate that they're more of an employee than a contractor. And this one, I think is tricky, is how essential, how key are the services of that worker to the regular business of the company. So I think that's one where, yeah, I feel like the IRS is pushing it a little bit there, but they're basically saying, well, if it's an essential service, that means that they're an employee. Well, I don't know that necessarily kind of is in line with the overall concept of an employee versus contractor, right? If the overall concept is, can the business director control how the worker performs the task? I don't know how essential the services are, how that kind of maps to that concept, but that's what the IRS says they look at in trying to evaluate that concept. They also use the phrase behavioral control. I'm just throwing these words and these terms and these thoughts out here because the moral to the story is that there isn't a bright line test. You have to evaluate the facts and circumstances based on these concepts as to whether somebody is a contractor or an employee. So, there's more I could say on this. There's carve outs and caveats and things like that. But I think I wanted to kind of get the basics on the table as a reminder. Like I said, we've talked about it on the show before, but I wanted to throw the basics out there. The IRS is reminding us it's probably good for our audience and for small businesses that might be listening to us to also kind of have this in mind. Consider, are you at risk here? Are you treating people as contractors who really are employees?
And I appreciate that reminder, Ty, because one of the things I wanted to add, unwinding that, in terms of when you say you're thinking that you're operating as a contractor, or you're having someone operate as a contractor, and then you find out that they're actually truly an employee, and you have to kind of do the whole kind of review and analysis after the fact, is much harder than actually analyzing it from beginning and getting it set up right. So I think these reminders are really great reminders for people to have as they're, thinking about bringing people on. And if they are an employee or a contractor, making sure you get it right from the start.
Yeah, no, I think you guys have it exactly right. And just to add on, I mean, if I'm an employer who's thinking about paying somebody in a way that if I can trick somebody into being a contractor when they shouldn't have been, I'm thinking about doing that. The thing that would then keep me up at night in that situation would be that the worker can file the SS8, the determination of worker status. And at that point, nothing, like Ty said, everything that you agreed on is just evidence against you at that point. And then also, nothing that we agreed on ends up mattering because, like you said, the facts and circumstances of what's happening are going to be what drives that. And so, I mean, and then the last thing is that if the worker understands what he's being paid, then sometimes the benefit you think you're getting by paying somebody as a contractor as opposed to an employee it would be accounted for by the worker if they understand the tax. So they know what their overall outcome is anyway. And so if they're really evaluating your offer, even with your proposed setup in mind, it's still just a question of what your total compensation is. So you're not even really getting away with something even when the guy agrees to it, because he's just looking at total cost of compensation if he's paying attention.
And by the way, I think there's a couple things that you guys said there that I want to follow up on that are key points. And one is that that's how most often small businesses get in trouble over this, is that they get turned in by a worker who basically is disgruntled and says, and often they go to the state because, this is another thing that gets confused in this area, is that there's laws governing contractor versus employee at multiple levels for different issues. So, the states have their own laws on this issue, which relate to labor fairness and labor equity issues. The Fed also has labor equity rules around this too. So the Fed Department of Labor could get into it, but it's not as common. But state departments of labor get into this all the time. And so then that, a state determination can lead to the, as Tammy was talking about, if you have to unwind this because, let's say, the state gets into the issue because they, the employee, turn them in, or or not employed, but however you want to define the person. The worker had a disagreement with the company, and then realized that maybe they could get more out of the whole deal by going back and claiming that they weren't paid appropriately or given the benefits of other employees, and they go to the state on that, and then that just unwinding that, like Tammy says, becomes a mess, and then it goes to the Fed, and you have your IRS issues on top of that. But it could go the other way. It could be that the IRS makes this determination in an IRS audit, because that's one of the things they always are going to look at is, who did you pay 1099s to? And, is there any evidence here that we need to look at people might not be contractors? And then once the IRS makes that determination, then you're unwinding it back the other way with state issues, right? But so this could be at either one. But the reason I bring up that this could be at either one, and that you're often turned in by these workers if you're a small business owner, is that sometimes people get confused. They hear rules that are applicable to some particular state, and then they think that's what applies. Like there are some states, I've said that the IRS doesn't have a bright line test, and they don't, but there are some states that do have bright line tests. And so sometimes people get confused because they know that their state has a bright line test for whether they're a contractor or not. Okay, that's fine, but that doesn't change this determination for IRS purposes, because it's a different jurisdiction. And so that's one thing. Now, the other thing that was kind of talked about with Charlie that I think is important to highlight here is that there are many cases where the worker themselves wants to be a contractor. They want to be an independent contractor, and what's important to recognize is that this is not a matter of agreement, right? It's a factual determination. Just because as the company, you want them to be a contractor and the worker themselves wants to be treated as a contractor, which maybe they want that because while the truth is they have no other clients and they really are like an employee, they want to run like a business on their tax return and deduct a bunch of expenses as if they're a business. And that might be their motivation for wanting to be treated as a contractor. And, so if they're a little more kind of tax savvy, they may have a motivation there that they want to be treated as a contractor. But my point is, it doesn't matter that they want to be treated as a contractor. The facts are still the facts. And that's what determines if somebody is a contractor or not. You two, the employer, the company, and the worker agreeing that they could be contractors or they should be contractors doesn't change this answer. So I think, all of that, I'll get off my high horse and turn it back over to Charlie.
Yeah. So if you are having trouble paying your employees, right, one way you can get around it is to just pay them all through Venmo, PayPal, and Cash App and report nothing, right? No, wrong, because now there's an article in Daily Mail that says Venmo, PayPal, Cash App are all going to have to report transactions totaling more than $600 to the IRS as Biden plans to ramp up financial enforcement. And so I'm going to go through just some of the key points of this. It's a pretty big change for individuals, and so it's going to be kind of good to know. The new reporting requirement is going to ensure that small businesses receive payments through those apps are paying the fair share in taxes on them. So that's the motivation behind all of this. On January 1st, 2022, that was when this legislation kind of kicked into effect. And basically, the changes are going to be in effect for the entire 2022 tax season. It was previously true that payment apps were required to send a form called 1099-K to vendors whose gross income exceeded over 20,000, or if they had more than 200 transactions per year. But this changes that limitation down from 20,000 to 600. And not only is that a large kind of percentage change, but it also is a really meaningful change in the sense that I could see a lot of people who fall into the bracket of being slightly over or near 600 for those kinds of services. That's like a pretty specific point. And so I could see that being popular. And then let's see. So a couple of other things just to think about. This was part of the March 2021 American Rescue Plan, which the article notes passed with no Republican votes. Couple of exceptions. The new rule is only for goods and services, not for personal. So if you're like paying a roommate for rent or you're reimbursing a friend, it's not about that. It also excludes anybody who's selling like a personal item at a loss. And so those aren't considered either. And then the one point I kind of picked up on that I thought was interesting and wanted to talk about a little bit is it said that Republicans have said that this proposal amounts to Biden administration peering into Americans' everyday purchases. And so I guess I want to hone in on that. And at first, it kind of made sense because I thought, well, if we're going to have to report everything that goes through every system to the IRS, well, that's extra reporting. Somebody's looking at it. But then when you think about what the exceptions are, it seems like to a lot of people, this wouldn't apply because the only way this happens is if you're collecting payments for goods and services that you're selling. And those people should have already been doing it anyway. So I don't know, I want to get your guys' take on, do you think this is going to increase compliance? And does this amount to Biden administration looking through your everyday purchases?
So this is interesting. I think that at the end of the day, when you said the fact that they really should only apply to people who are selling something or a service or a product and getting money for it, and it's a better way of tracking it to ensure they're reporting that to the IRS. I think the challenge is that in the past, some of those things that were happening over, whether it be cash, Venmo, PayPal, all those different things, they weren't being captured or reported, and that's kind of like what it's trying to combat, right? So if you are selling services and you're selling goods, then this shouldn't be a big deal to you because you should have been reporting those anyways. The truth of the matter is, in some cases, probably people weren't. And so this is kind of forcing it and therefore forcing compliance. Although I'm not quite sure how that is going to how do they know in terms of whether it's selling a good or service or just reimbursing a roommate for rent or all that kind of stuff? Is that there going to be tags for that, or are there going to be some review of that? Because how, what if that's wrong and all that kind of stuff? That could be a little bit messy, but it just seems like it could be easier if you want to look on the positive side, an easier way to track that kind of stuff. So you're not having to do it on your own Excel worksheet or pad and paper if you're totally old school and you're really keeping track of those payments. I don't know. What do you think, Ty?
Yeah, I mean, I suspect the reporting requirements are getting ahead of the data analysis abilities of the IRS anyway, in the sense, to this question of like, what are they going to do with the data and how are they actually going to apply it or match it to anything that is used for tax purposes. And we've seen this before where they've rolled out kind of reporting requirements, and then it was like, well, we don't really have the ability to match it anyway on the IRS side. We don't have the technology or the manpower or the people power to make it happen, right? And so, so, yeah, I think there's that part of it. It's like, okay, yeah, I mean, it's the information's there. It kind of lays the tracks for something in the future, right? But I have my doubts that they really have any way of making use of the data. And to the question that you put out, like how would they even know whether a payment was for business or not business? I would point out that, from what I've heard and observed, that even the payment processors themselves, like Venmo and PayPal, they don't even know sometimes whether those payments are really used for. They don't really know sometimes whether those payments are actually used for business or not, because they often have like agreements, or they have terms of service that don't let you use them for business unless you pay some kind of fee or something like that. And so I know a lot of folks, they will transmit or they will process things through these kinds of services as if they're just like transferring funds between friends and family when it's really business oriented. I think that's very common. And so, the fact that the payment processors don't even necessarily know enough about that to capture that and get their fees for it, yeah, the IRS doesn't have a snowball's chance and of possibly really doing that right now with the kind of data processing abilities the IRS has and doesn't have.
And I think for most of the time when I've done payments on any type of app platform, usually it allows you to put in the description of what you're paying for. So some people are funny and they're like, oh, I'm paying you for, ice cream, or I'm paying you for whatever. And it's like, it has nothing to do with actually why the cash is being transferred. So I'm not sure how they're going to kind of collect that data, or if people should be a little bit more thoughtful as to like what they're putting in those description fields to say, I'm reimbursing Charlie for my rent, not that I'm paying Charlie because I'm renting his house, right? So like really trying to clarify some of those things. People might be thinking about what they put in those descriptions more so than anything else.
Yeah, and it's kind of interesting because, with PayPal, when you send money back and forth, there's a question of who pays the fee, because every time money goes back and forth through PayPal, somebody's got to pay the fee. And usually that question of, are you buying something as an individual or as a business will drive who's the payer of the fee. But that goes away. And so you could imagine them using that to try to drive who's the seller in this case. But, Venmo doesn't charge a fee to transfer a lot of these different types of transfers. And so there's nothing, you can't really use that as a characteristic. So like you guys said, I think I could see this getting really confusing to try to use in an effective way from the IRS's side of things. Do you have another article we can go through, Tammy?
I have an interesting article from Bloomberg regarding recent chicken price fixing case that ended in a mistrial back in December. The case involved 10 current and former chicken company executives that were charged with fixing prices and rigging bids in the poultry industry from 2012 to 2019. One side is arguing that the chicken executives conspired to raise prices and united together to hold prices even when customers were asking for decreases. The other side is arguing that they were merely sharing pricing information, which they don't believe is illegal, and that there's no proof of a conspiracy. The jurors were deadlocked. So I find this pretty interesting because not only does it include the big names of the poultry industry, which is Tyson, Pilgrim's Pride, and Purdue Farms, but we're also talking about a $95 billion dollar chicken market. And these are individuals being charged, and they could actually face prison time and $1 million fine, which according to the article is unusual. So I did a little digging and found that while the maximum penalty in the law is $1 million fine and up to 10 years in prison, in most cases, antitrust violations were, imposed fines without prison time. So this would be kind of unusual if they were to be found guilty and face not only the criminal fine, but also the time in prison. What I also find really fascinating is that Pilgrim Pride has already pled guilty to price fixing and will be paying over $100 million in fines. And then Tyson has stated that they are cooperating with the investigation to take advantage of the government's policy to grant leniency to companies that were first to disclose illegal price fixing. So it seems like it occurred, right? So, like in that cases. So I guess the real question for debate would be, how involved were these individual executives in this alleged scheme, and what punishment should they face? So what do you guys think?
I mean, they should definitely face the full extent of punishment if they were guilty of price fixing, because it could be chicken, it could be anything. Once you start involving derivative financial investments and then manipulating the price, anything becomes possible. So it's like, yeah, I think if they can be found guilty of the things they're accused of, and if it can be proven, then I see no reason to spare them of anything. Is my take.
Yeah, I think I agree with Charlie. I don't see any reason for them to get too much leniency on doing this. I mean, yeah, I feel like, wasn't there like something about it, like a chicken shortage and prices going up last year? It seems like this article is well timed in that regard. It's like, okay, well, yeah, then what's real and what's not real on this stuff? Yeah.
Yeah, I guess the real what's challenging is to say how involved were the executives in this and participating in this, because obviously the companies, whether Tyson indirectly by saying they're going to cooperate in hopes of leniency, that would lead you to believe that they were aware of something, at least as a company. And with Pilgrim Pride already, pleading out, essentially, they were involved in it, and so these are their executives that are now trying to face these individual kind of crime or penalties that could happen. So it's and I think it's interesting that the jury was deadlocked and could not reach an agreement as to whether or not the individual executives should be held accountable in what their involvement was in that. But I think what this kind of the moral of the story would be, obviously don't, fix prices and do all those things in violation of all those antitrust laws. But what, as an executive of a company, I mean, it would be hard to imagine that you weren't at least aware that this was occurring, or at what level of participation that you have in it, and that you could be held individually responsible and be facing a very stiff penalty in that.
Yeah, I mean, well, for sure. I mean, there's no way that the executives of the company at the highest levels didn't know that they were agreeing with other companies as to what their pricing would be, right? How do you claim not to know that? That's crazy.
Well, it's like, why is it so that the juries are deadlocked, right? Like, it seems like there's got to be something there that's like it's causing people to kind of pause to say yes but no, and so like not being able to reach a verdict. And granted, just as a note, that they're going to read their retrial is set for February of this year, so it'll kind of come to a conclusion hopefully by then. But it is a very interesting kind of situation where I'm not sure why the jury kind of couldn't unanimously come to a conclusion on this.
All right. Well, it'll be interesting to see what happens. And yeah, I'm hoping they get locked up. Do you have no, I'll get it. Just kidding. Do you have another article we can talk about, Ty?
Yeah, I can finish this off with an article I was reading about the concept of having a book tax. Now, the concept as it's come up was a proposal that was part of the Build Back Better bill or plan, which hasn't passed. And so and who knows if that or any version of it would pass. But where it came from originally was part of the Organization of Economic Development, this kind of worldwide organization of nations, like trying to get kind of some playing rules across the globe in terms of corporate tax in a multinational way. And one of the concepts there was, well, we need to have like a corporate minimum tax that is applicable to no matter what jurisdiction the company's operating in, and that'll kind of prevent companies from constantly just shopping jurisdictions and moving operations around to arbitrage various countries' tax rates. But part of that discussion of having a minimum tax then led to, well, in order to get to a minimum tax, part of it's rate, but part of it's also how do you compute the corporate income, the base that you have the tax on. And so the proposal that has been out there from in terms of the World Organization has always been, well, it should be based on real financial income, not some kind of not some kind of skewed concept of taxable income that's defined by some individual jurisdiction's tax laws, right? And so this made its way into as part of there's a bigger saga going on here, and that is that the Biden administration and Janet Yellen as the Treasury Secretary has been trying to get us in line with other nations in the world to like create this more globalized tax system for multinational companies. And part of that was inserting this idea in the Build Back Better bill that there would be a corporate minimum tax and it would be based on their financial income under GAAP. And now it was only going to apply to companies with like billions in revenue. So this is not a small business topic. This is more of a philosophical discussion to end our day with here. But what was interesting to me about this from an accounting philosophy standpoint is the accounting academic community came out and wrote letters in to basically say that they disagreed with this proposal to include this tax on book income or tax on financial statement income. And these were primarily financial statement theorists financial accounting theorists, academics who basically opposed this concept. And the reason it's kind of interesting thinking when you look at it is the reason for this is that they don't want the pressures that you have on taxation in terms of how you determine taxable income, they don't want those pressures to affect the calculation of financial accounting income, which is used for our capital markets, right? So financial accounting income, which is defined by rules that are set by the Financial Accounting Standards Board, which is ostensibly a board that is independent of the government. That financial accounting income has always been considered kind of sacrosanct away from taxable income, something that is isolated from how you compute taxes and should be based on the best rational thinking that accounting theorists can come up with of the day. Now, there's lots of debates over whether GAAP financial income is the best way to measure income or not. You can get into those debates all day long, but conceptually speaking, it's designed to be separate from taxable income to avoid and separate from the independence of governments. You can also debate whether it's really true that it's independent of interference from governments, but it's trying to be independent of the interference of government so that markets, capital markets, the stock markets, and those who use financial accounting information can have good, reliable information that isn't skewed by the political whims of how you should calculate income that day, right? So anyway, that's what these accounting theorists are pushing back on, is they're saying, these aren't tax theorists, these are financial accounting theorists who are writing into the government and signing letters and saying, hey, we don't want you to tie your tax code to our financial accounting income, because if you do that, then Congress and the rest of you are going to come put pressure on our Financial Accounting Standards Board, and you're going to start messing with how we define income for financial accounting purposes. And we don't want that. We want you to stay away from us. So don't create a tax that's based on our book numbers, because we don't need you interfering in our calculation of book income. So that's the philosophical point that is being debated there. And I'll turn it over to your thoughts.
Yeah, well, I mean, I would say the key thing here is if we can accept that the goals of the financial statement users are different in each of those two use cases. The government is trying to figure out how much tax they should levy. And I'm using the term government obviously loosely because we're talking about this world organization, but one's trying to determine tax, the other is trying to really figure out use the financial statements to get a feel for how they think the company will operate into the future. And those are often similar objectives. They kind of have a lot of the same information and pieces to them, but they're not really the exact same question. And so I just think if we can accept that there's different users with different objectives of this information, then we can accept that there's two different ways to look at it, and that there should be a difference between book and tax income, and that there's actually like a real reason why. So that's my thoughts. What do you think, Tammy?
I'm going to answer a question with a question. I guess if the governmental view is that they're going to use GAAP financial statements, then is there really going to be a kind of is a fear that they're going to muck around and like want to influence what GAAP means and make changes to that? Is that really true? Or it could, if they kept their hands out of it and said whatever GAAP is, which has been reviewed and approved and all this kind of different stuff, that they're really just utilizing the financial statements to do the tax calculations. Would that be okay? Is it really just because of the fear of that the government's going to start changing what GAAP means because of some tax thought process and how they want to, it would be better for it to be viewed in a different way for tax purposes?
100%. Yeah. I mean, that's the paradox of the whole discussion is that the governments are wanting to use the credibility of financial accounting to base the tax on. And the financial accounting world is saying our credibility will be shot as soon as you base a tax on us, because you can't keep your hands out of messing with us.
Yeah. So then would an easy solve be for them to promise to keep their hands out of it? You know what I mean? Because I think that it's just a hard way to kind of to do it. And I mean, I see where the governments are coming from, and it's easier to figure out a standardized way of interpreting what information it is to determine the tax calculations. But they would have to promise to keep their hands out of it, because you're right, the credibility and the if changing things is going to be a hot mess.
Well, yeah, I mean, that would be the solve, but I would take exception with saying it's the easy solve. I don't think that, yeah, I would side with the financial accounting theorists and the idea that they can promise all day long to keep their hands out of it. But, in our republic, we don't, our politicians don't follow rules or norms or, philosophical rationale very well, I would say. So, I mean, I would say that I would be highly skeptical that you could do that. If the incentive to interfere with financial accounting standards is there, then I think we can nearly guarantee it will be interfered with despite any promises. But I think, another point on this that's also interesting is the fact that without tax and government interference, right? Like if you think of this in a very simplistic manner, you'd say, well, you would presume, and there are complexities which may make this not true in every case for every particular fiscal or tax year. But just to make it simple, you would presume that what you're afraid of is that the tax people would be influencing accounting standards such that they would be lowering the amount of income in any year in order to lower the tax base and the tax that has to be paid for their constituents, or perhaps vice versa. You would also presume on the other side that the people who management and people who are primarily interested in financial accounting results want income to be reported as high as possible to boost market results. And so, is there a counterbalance there? Like is the force of is the forces within the tax world that would be trying to skew rules to lower income or the calculations of income, are they counterbalanced by the forces on the other side who are constantly trying to skew the calculations to increase income in any particular period? Do those two forces potentially offset each other? And therefore, maybe that's what we should count on, is the offsetting effect of two different forces who are neither are going to be operating with purity of mind, but their lack of purity in opposite directions might get us to a stable answer.
Or is it just that they need to accept that there's two different systems? I mean, maybe we don't meet in the middle. I mean, I'm thinking specifically about Section 179. I mean, the government has that to incite people to make purchases, and then they deduct them immediately. And then when that business reports to the bank, they would want to report all of its assets. So GAAP says you would report those as fixed assets. And so my point is, those are two different answers that are going to change how it plays out. And we could look at those two and say, should we meet in the middle? Or we could look at it and say, is it just okay that there's a reason why one is set up the way it is and the other is set up the way it is, and that the users of these two financial statements, the government trying to figure out how much it should tax you, given that it wants you to spend all your money on computers, and the bank who just wants to know what you have in your warehouse, they're just asking two different questions. And that's okay. That's totally fine. I mean, that's how I look at it. Maybe I'm overthinking it, but yeah,
I think that's fair. I mean, let's leave it to Charlie to end this with a practical answer.
Thank you, Charlie.
No problem. All right, everybody, that's going to do it for the None of Our Businesses YouTube show and podcast. Please tune back in again next week for more business updates from an accountant's perspective, and check out our sister podcast, Profitless on Purpose, where they're discussing anything and everything relating to the nonprofit space. Thanks, everybody.
Bye, everyone.